market is weakening, yet we're still seeing decently high inflation reads. Hello everyone, I'm Seth, this is Acquired Seller. In today's video, I'm going to react to CNBC's piece on why Fed rate cuts aren't making mortgages cheaper. Before we get into it, if you're new here, welcome. If you're returning, welcome back. I'd greatly appreciate if you drop a like on the video. With that, let's jump into things.
Getting a mortgage in the United States is expensive.
I think that we're seeing some strain in the system, but until mortgage rates come down and supply increases, we're not going to see prices come down.
Just simple supply and demand, and when money is expensive as it is with high rates, yeah, obviously people are not going to be able to afford things.
The average rate on the 30-year fixed mortgage today is hovering around 7%. In 2021, rates were at all-time.
And this was on December 16th. The FOMC just came out and they cut rates another 25 basis points, but the actual interest rates, looking at the 10-year Treasury, went up. So things have actually just gotten tighter in the market rather than looser, which is going to put more strain on the affordability of homes.
Time lows. Consider how that affects the financing for the typical American home. With 2021's rates, interest payments would cost around $157,000. If it were financed in 2024, the cost jumps by a lot.
Right now, we have high price.
Yeah, just look at that. Total out-of-pocket for the same price of home going up from $578,000 to $883,000. It's no wonder people can't afford homes with today's rates.
And high mortgage rates, so it's a double whammy. Housing feels especially unaffordable.
Mortgage rates in the U.S. are determined by many factors, including the decisions made at the Federal Reserve.
We think that our policy was appropriately restrictive.
The place where the average citizen felt the collateral damage the most painfully, I think, has been in the housing market.
The Fed is now cutting interest rates, but that's not making it easier to buy a home.
I think.
Yeah, as I said, the Federal Reserve, even though they're cutting rates, the Treasury is having an inverse reaction. So rather than making rates come down, they've gone up, which is just going to further decrease affordability and put more restriction on the economy and mortgages.
The best case scenario is we're going to continue to see mortgage rates hover around 6.5% to 7%.
So why are mortgages so expensive, even as the Fed tries to ease economic conditions?
Well, a part of the reason that the market is reacting negatively to the interest rates cuts is because the market is in general concerned about inflation, even though the Federal Reserve has a dual mandate of stable prices, so no inflation, no deflation, as well as a strong job market. At this point in time, the job market is weakening, yet we're still seeing decently high inflation reads. PCE came in good this morning. It was 0.1 when I think it was 0.2 or 0.3 was expected. And the market reacted positively to that. However, it still doesn't change the fact that the market in general is still concerned about inflation.
The Federal Reserve's recent policies have had a dramatic effect on mortgage rates.
You had these record low mortgage rates during the pandemic that fueled all this buying, which pushed home prices up.
The Fed then raised interest rates to stop inflation.
We raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant.
Well, the Fed implemented.
Obviously, it's not going to be pleasant because it puts restrictions on how easy it is for companies, or how cheap it is for companies to get loans. And if it is more expensive to get a loan as a company, you're less likely to take that loan, which further reduces the chances that they're going to invest in capital growth. And when companies are restrictive there, they're going to be less likely to provide substantial raises or hire to a great degree, which is what we're seeing in the labor market. Is the labor market's weakening.
And what some people have called a rate shock. It has resulted in a market that really.
Yeah, just going back to this table, that's like the fastest the Federal Reserve has ever raised interest rates in recent years, for sure. Which is where, if you looked at Cathie Wood's argument, she was like, whoa, they're increasing way too much. Obviously, the market is not going to. The market hasn't 100% agreed with Cathie Wood perspective on it, but it was an interesting perspective to keep in mind that the rate at which they were raising rates was very dramatic, and still, from that standpoint, we're just digesting and really seeing the impact of these rate increases in today's market now.
And what some people have called a rate shock. It has resulted in a market that really is just not functioning properly at the moment.
This sudden jump in financing costs created a lock-in effect in housing.
The lock-in effect itself came from the Fed raising interest rates relatively rapidly in 2022. So if you look at the interest rates that mortgage holders have out there in the market, over half of borrowers actually have an interest rate below 3.75% on their home.
And this is because there was a buying frenzy in 2021 with the low rates as well as 2022. And now, since everybody has such a cheap rate, in order to make a horizontal move from a house that's the same size, it's now more expensive, so people aren't moving. People have really cheap money and cheap loans, cheap mortgages. So the incentive to move when it's going to become more expensive is not really high, especially when the job market has not been as hot. So people aren't getting as substantial of raises, making it hard to justify moving, even if it's a horizontal move, to something that's more expensive.
Folks are holding on tight there. That means less homes coming onto the market as those folks hold on, which means less housing out there to buy.
This leaves home buyers with fewer options on the market and a high cost to finance any home that they find. As a result, 26% of the homes sold in the United States were paid in full with cash.
I'm really curious to see how they pulled these numbers, because I know when I was house shopping in 2021, it was 2021, from that, there were programs where you could essentially pay in cash, but then you would have a mortgage with the company that paid in cash for you. So is that considering these numbers? Are those 26% of purchases with cash people using those programs where a company will come in and pay cash for the home, but then you still have a loan with the company? I'm really curious about those numbers.
In 2024, an all-time high. The remaining 74% of home buyers relied on mortgage financing. Those new mortgage holders are on average paying over 35% of their income on housing.
Honestly, that's lower than I would have expected, considering the fact that the max debt-to-income ratio that people can have when taking out a mortgage is 50%. I would think a lot of Americans, due to financial education, would end up over-leveraging themselves, and that's how you find people being house poor or spending all their income on their housing, which people already spend all their income on renting. So when it comes down to it, if you spend all this equivalent amount of income on a house that's going to have a leveraged appreciation, that is still a better alternative, in my personal opinion, than spending half your income on rents.
Think about a 30-year mortgage. You're going to your bank and you're entering into a financial obligation to make 360 payments, and then the mortgage is paid off. It doesn't usually take 30 years for a mortgage to get paid off. In fact, the average effective mortgage maturity is only about 8 years.
That's how long folks typically hold that.
I found that the average mortgage being 8 years is kind of insane. I mean, overall, I think it is good to take out a 30-year mortgage, and in terms of risk, you're reducing your risk, because you can always turn a 30-year mortgage into a 15-year, but you can't turn a 15-year into a 30-year unless you refinance. And then, of course, at this point in time, if you want to refinance, you're going to have more expensive interest, which may end up making the refinancing a wash.
Them before they're either selling and moving to a new home or refinancing to reduce their interest rates.
Many Americans are waiting for interest rates to fall. The Federal Reserve started a rate-cutting cycle late in 2024. The Fed's main tool, the federal funds rate, determines how money flows between banks. Lower interest rates can make loans cheaper, but so far, this has only had a limited effect on mortgage rates.
The interest rates that they can set are...
The reason it has had a limited effect on interest rates is because the market is concerned about inflation, so the market is pricing in the Federal Reserve having to increase rates again to combat inflation, because inflation has been sticky.
much less effective than most people assume. Since when they announced the first rate cut, the Treasury rates have gone up, the mortgage interest rates have gone up. They're trying to persuade people to do things in the market, but the market has its own logic, its own intentions.
It's not likely that home prices come down, typically. It's a much better hope to find affordability from rates coming down, and that can certainly happen, but it is going to have to come as a result of weaker economic data, lower inflation, or significantly less government borrowing.
Mortgage rates are greatly influenced by the U.S. economy. Bankers keep track of that by observing the yield, or return on investment, from loaning the government money for 10 years.
Yeah, and currently the yield curve is inverted, or I actually didn't check the rate today, but the yield curve had inverted in 2022, and it has stayed inverted, and it's kind of teeter-tottering back and forth right between being inverted and uninverted. And when it comes to recession concerns, when the yield curve has inverted and then goes uninverted, I think it's around 50 basis points uninverted, that concerns of recession come to a more significant concern.
Your treasury investments are thought of as relatively risk-free. You're lending money to the federal government, you know they're good to pay you back.
Some investors think the treasury yield could rise from here.
If folks start to feel like our spending is getting a little bit out of whack, and they start to question if the U.S. citizen can actually meet this tax bill further on down the road, they may want higher compensation.
New mortgage rates change over time, roughly in line with the 10-year treasury yield. But there's an additional fee baked into mortgage rates to account for the risk of taking on the investment. The amount of the additional fee is called the spread.
Most of that spread is accounted for via risk. When you look at mortgages, there are a couple of kinds of risk that are added there for that spread. One of them is credit risk. If I lend money to an existing mortgage holder to refinance their loan, or a potential home buyer to buy a new home, are they going to be able to pay me back over time?
Yeah, and so credit risk is something that we ran into in the 2008 financial crisis because there was ninja loans, and from then we have changed policy rules and restrictions around who can qualify for a loan. So credit risk is certainly reduced in comparison to 2008, but again, it is always something that is taken into consideration when a bank is looking at giving you a loan to finance a house.
Additional fee baked into new mortgage rates on the market has increased since the Fed started to tighten the economy. As a result, people who take on new mortgages are paying more than they otherwise would in normal economic conditions.
But it's not as if a mortgage lender is looking at a 10-year treasury yield and simply deciding what mortgage rates are going to be based on that. In fact, there are an entirely different set of bonds called mortgage-backed securities. The demand for mortgage-backed securities can wax and wane, and it's the price of those mortgage-backed securities that directly dictates what a mortgage lender can charge.
Today's mortgage rates are also influenced by the Fed's response to past emergencies.
Global financial crisis was in large part driven by a significant housing correction. And so in order to try to stabilize the housing market, not only did the Fed commit itself to buy U.S. Treasury debt, they also committed to buy agency mortgage-backed securities.
And that had a distinct downward pressure effect on rates.
In this process, the Fed buys huge amounts of debt to alter demand in the bond market.
It shifts the supply-demand equation out there, effectively reduces the interest rate on mortgages that's being offered out there.
Mortgage rates fell through the decade as the strategy played out, which made financing a home cheaper. The economy eventually recovered. The Fed returned to this technique in the pandemic.
They were extra aggressive in 2021 with buying mortgage-backed securities, so the QE, and that was ill-advised.
QE is quantitative easing.
In hindsight,
the Fed is now reducing the amount of mortgages that it holds. Experts call this process quantitative tightening.
Yeah, so again, the Federal Reserve pretty much they can set the federal funds rate, and then they can do quantitative tightening or quantitative easing. So the Federal Reserve is still quantitatively tightening things. However, they're also working on the FOMC rate and reducing that. So it's kind of a discordant effect on the overall economy because they're still doing things that are increasing the restriction while also trying to reduce restriction with the FOMC rate.
Quantitative tightening is the exact opposite. They now have a portfolio on their books. They don't want that anymore, and they begin to slowly let that run off.
This is an experiment that's never been done before. I think that's one of the reasons the mortgage rates are still going in the wrong direction from the Federal Reserve standpoint. And that's a problem.
Again, I think a part of the reason that things are going in the opposite direction when it comes to the Treasury rates and therefore the mortgage rates is because they're acting in counterintuitive ways. Rather than having rates come down and quantitatively easing, they're still quantitatively tightening but dropping rates. So they're taking actions in opposite directions.
It's a political problem as well as an economic problem.
Bankers believe the Fed could complete its current cycle of quantitative tightening in 2025.
When you look at the Fed...
Yeah, and with the most recent FOMC meeting, the Federal Reserve talked about they reduced their FOMC rate cut projections. So just before this last meeting, they were anticipating 4 more rate cuts, so 100 basis points of cuts throughout the year of 2025. But the most recent decision brought that down to only 50 basis points of cuts, which likely means they're going to have a pause in the January FOMC meeting.
Fed's interaction in the mortgage market, I think, in a short synopsis, I think they would prefer not to be there. They don't want to disrupt the market too quickly, but they do want to gradually exit that market.
The Fed's best estimate suggests that mortgage rates could trend above 5.5% through 2025. Other forecasts
I find that to be pretty likely at this point, especially considering the FOMC just changed their rate cut projections for next year.
are higher.
I wouldn't be surprised if you see mortgage rate maybe settle down in the low 7% range, say 7 to 7.5%. So unfortunately for those homeowners who are looking for a bit of a reprieve on the mortgage rate side, that may not come to fruition.
All things considered, it is still extremely cheap in comparison to something like this. I can't remember the exact year, but there were interest rates on mortgages in the 17% range. So it's still cheap relative to that time period, but in comparison to COVID, which is much more memorable for a lot of people, it is extremely expensive.
The decision to buy or keep renting is heavily influenced by prevailing mortgage rates. Renters are currently paying $1,000 a month less compared to owners with a mortgage. That said, the 30-year fixed-rate mortgage is a unique benefit for Americans. Many other countries use adjustable-rate mortgages that respond more quickly to central bank decisions, for better or for worse.
It makes for a lower payment than you might otherwise find, and it makes for more certainty. Some would say that we end up paying more interest over time as a result, but others would say it's a luxury that helps us afford more home than we otherwise might want to buy. You don't ever want to assume that rates are going to do something in the future just because people are saying they will, or because you feel like they will. Rates are where they are today, and there's really no guarantee that they'll be there tomorrow or that they won't be higher.
In an ideal environment, the Fed's not doing anything. But when the Fed is active, they absolutely do have an impact on what you're going to pay to buy a new home.
Yeah, overall, the Federal Reserve has a dramatic impact on how expensive money is, and we're in a really weird time period where the Federal Reserve is dropping the federal funds rate, yet the treasury yields are going up. It's discordant, and if you study the security industry essentials, like to take the security industry essentials exam, they always talk about how when the FOMC drops rates, then yields come down and mortgage rates come down. But that is currently not what we're seeing, which is kind of a conundrum at this point in time. I'm curious though, what do you think? Please share your thoughts and comments in the comment section below. And if you've made it this far into the video, you may as well subscribe to the channel so you don't miss out on future videos just like this one. Or you can just check back on the channel at 6 p.m. Tuesday, Wednesday, or Thursday. Until next time, thank you.